Greetings. This is Dr. Jeffrey Scott, and this is my weekend market update for May 1st, 2022. My email address is on the slide, hgsidoc@gmail.com, and I titled today, Is the Bear Growling? Yeah, I think it is. This is for education purposes only. Anything recommended in the spirit of education should not be considered investment advice. I'm a doctor, not a broker. You should consult your financial advisor before making trades. The tools demonstrated are those that I use in my daily trading. I pay for the tools I use, and trading involves risk, and you alone are solely responsible for any investment decisions you make. Enough of slides. I've been using an Excel spreadsheet to review the markets, and because I just keep adding to it every week, it's easy for me. So let's start here, and I take these sheets here out of HGSI, www.highgrowthstock.com, and you could see that I've taken a number of the index ETFs, and let's just go over this column here, and I look at percent current interval from 52-week highs. Notice the Dow is now down 10.8, the S&P is down 14.20, so both are firmly in correction territory, while the NASDAQ and the Russell have now entered bear territory. And you could see how long it's been in each of these indexes since we saw a 52-week high. If we look on the week, you could see over here on 5-day price change, the leader was the VIX, so you know if you're trading equities, if the VIX is up, the market's probably down. The 8.6 here just shows the benefit. I've been talking about the contra ETFs for some time. The SQQQ up 8.6% in a down week, so it's leveraged to the Qs. The dollar was up some, as well as commodities and oil. The biggest losers was the Qs, down 12%. Bitcoin down 5.9, the IBD 50 ETF down 5.2. Biotech continues to be extremely weak, as FANG as well. If we look at the sectors for the 5-day change, you can see everything is negative, and what got hammered the most was consumer discretionary, real estate, which you would think might be defensive, got hurt as well, as did another potential defensive play, utilities. The leader in the least amount of red, technology, interestingly, over 5 days, starting to stir some, and 0.8, the material sector. Energy continues to do okay. Staples, another okay is I guess an overstatement, continues to do better than most. Staples only down 2% on the week, and healthcare 2.5%. If I look at another way of looking at the markets, this is from my good buddy Cigar Nandy from his tradingprofitably.com, and you could see a couple of things I like to look at, but let's just look at this chart right in here. This shows you sectors 1 day, 2 day, 5, 10, and a month. And if you go back 2 weeks, you could see all sectors are down over the last 2 weeks. If you look at Friday, 100% were down. Over the last 10 trading days, 91% of industries are down. On Friday, 99% of industries were down. And then over 2 weeks, 84% of stocks were down. And interestingly, on Friday, 95% of stocks were down. A rough week. Now, if you look at the warehouse report from EdgeRater, I'm basically taking a list of all the stocks in the market, and I'm looking at the fundamentals of a week ago, whether it was EPS rank, earnings per share, relative strength rank, or group rank. The further to the right, the higher of the individual parameters. If I add ERG together, I get ERG. Again, the further to the right, the higher the parameters. And then I look at performance, and you could see that all EPS ranks and all relative strength ranks were negative this week, although you had less negative and high relative strength stocks and stocks with earnings. So the ERG looks like it's favoring growth, with the higher growth, the higher ERG doing better, but notice that everything's below 0%. So it was a tough week in the market. On the NASDAQ, no evidence of a Hindenburg, so we can move right through that. But look at the percentage of the stocks making new lows in the NASDAQ composite. 18.36 on Friday, 17.96 on Wednesday. On Tuesday, 21%. Those are big numbers. So you start to wonder, are we getting oversold enough, at least in the NASDAQ, that we might expect to see a bounce? You could see on the week down 3.9 and 23.9 from the prior high of November 22nd. NYSE, the last set of Hindenburgs were early in April. Also on the NYSE, we have really high percent new lows. The reason why there's no color in the percent new highs, I usually color when it's above 2%, although here's one that I should have colored. So let me color that in here because I'm going to keep this sheet rolling. There was actually a kahuna, which is a bullish signal on the NYSE on Friday, but it clearly did not make a difference as the market had only 4 new highs and 255 new lows on Friday. Again, on the week, NYSE was down 2.8%. Let me just fix this so I can format. 10.5 off the highs here, as you could see. If we look at the buckets, take all the stocks in the S&P 1500, and I ask how many stocks are above the midline. You can see it's only 14%. So that means 86% of the stocks are below the midline or their Bollinger Band. That is decidedly bearish. We've got 25% of stocks are below their Bollinger Bands, also bearish. But unfortunately for those hoping that it means that the bounce is coming, I've seen it get to 90% of stocks below. We're not there yet. We might be getting close. We're not there yet. On the week, energy was strong, as I saw, down on the week, but energy stocks did better than many others. And you could see on the week, oil was down 1.5%. Natural gas continues to rally up 28%, probably on the backs of the deal between the EU and the United States on the liquid gas. And notice how the U.S. gas was up. And on that deal, we're starting to see some improvement in the nat gas in Europe. I wonder if the U.S. nat gas is going to continue to go higher if we're going to be selling in that market. If we look at metals, make this a little smaller, we can see that on the week, pretty much across the board, metals were down except for steel. Steel had a good day on Friday, up 3%. Iron ore was up 2.9. If we look at interest rates, and I'm going to make this bigger to make it easier to see. So let's see if I can't do that. The 10-year Treasury notes just going straight up. And that's probably what's driving the bearish sentiment in the market, or a big part of it. And if we look and notice how it broke from a trend line that went back many years. Similarly on the 30-year notes going straight up. If we look to the right, other things that I like to follow on a weekly basis, this is the Fed credit spread, up off the lows, but nowhere near the pain saw in 2020. When this starts to go up, it's a risk for the market. And we all know that on the 10-year, 2-year differential, we cross below the inversion mark. And we know that recessions usually follow these, but could be as long as 2 years to see one. Are we overbought or oversold enough that we need to rebound? So let's start here. If we look at stocks above the 200-day, we dropped. But look at this. There's a long way to go before we get to areas like we saw in 2008. And then back here in 2020. So we could still fall quite a bit more. If we look at stocks above the 40, again, we're down here. But when you look back at prior reversals, we still could fall a lot more. And then those who've watched me for any length of time know that I like this one here on the right, which is the T2121. And this one looks at the 13-week new high, new low ratio. And we're down here, but we're not down at we have to reverse level. So we could clearly get more oversold than we are today. Big economic news week. No other way of saying that. Monday, we got a PMI final. Tuesday, we got some job openings, factory orders, cool stuff. But the big deal is Wednesday when we have a Fed meeting. So you got ADP employment. You've got a statement at 2 o'clock and a Powell conference at 2:30. I think I can guarantee you two things. One, 50 basis points, because they've already told us that. And two, the market will be volatile. Thursday, we'll see some jobless claims and productivity. And Friday, as John Person, my friend, likes to call this, the monthly unemployment report, where we get the monthly unemployment rates, non-farm payrolls, hourly earnings, labor force participation, etc. Lots of major new market moving news. Speaking of market moving, there's something here for everybody. All right. On Monday, Devon, which has been a great performing this week, energy stock as well as Diamondback reporting. Also Mosaic, a fertilizer. Why do I point those out? Because they're all in my portfolio. You could see Starbucks on Tuesday afternoon and AMD. Moderna, Generac, one of my old-time favorites, which is out of favor now. Shopify on Thursday. DraftKings and others on Friday. I think we can say we have another big week of earnings. So, saw a broad-based sell-off this week as concerns rose or continues to rise. Another big week of earnings on tap. Bad earnings, revenue projections are weighing on the stock action. Ebb and flow of war and peace process continues to whipsaw the markets. I think on Friday I saw the markets drop, and I'm trying to figure out what happened later in the day when they started piling on, and all I could find was Zelensky saying that he thought the peace process was going to fail. We know we got 50 basis points coming Wednesday, but the interesting thing was that GDP that turned negative. And I saw all kinds of spinning by the press that it doesn't mean anything. But you know what? Maybe that weak, and I don't know how to spell weak, obviously. It's embarrassing. GDP will give the Fed an opportunity to pause this after this tightening, or to at least start talking about pausing. We are tightening faster than most other Feds in other countries. We've traded down to lows not seen in months. We are likely to see a rally sometime, and I think even this week. But remember, in bear markets, we can become even more oversold and treat any rally suspect. It is likely a bull trap. Think of how many days the market it trades up in the pre-market, opens, and then trades off the rest of the day. That is not the sign of a bull market. And I personally have the fewest positions since 2008. Let's take a look at the market using WealthCharts. And we'll just start with sort of the 10,000 foot view. And the first thing you notice when you look at the spider, the Qs, the diamonds, and the Russell, that they're all kind of in trading ranges now. The Russell trading down here to this January 24th low, and up here to the bottom of the prior Darvas box. And also notice it set a new low on the closing for months, and it closed near the end of the day. The spider has been trading between the 200 and that same January 24th low, and it broke through decisively on Friday, closing at the low of the day. The Qs, again, between the 200 and this January 24th low, broke through decisively, failed to retest, closing at the lowest low in quite some time, closing near the end of, at the low of the day, and ditto on the diamonds. The VIX is starting to stir. We saw that it was a big mover this week, and the dollar, cash is king. And don't forget, as you watch your life savings start to drift away, you can always cash in your stocks and put them into the dollar. And right now, the dollar's been strong. When we look at commodities, strong dollar, gold has given up sort of this rah-rah, cha-cha-cha that it had back here in February, and at best is in a trading range or selling off, which is more likely. Same with silver. Oil, I've liked a lot more because it came off its highs, but it's really gone steadily sideways. Had a new EMS come in Friday, and natural gas had pulled back. I'll show you on another slide. It's 17-day and bounced. And you can see here again, the 10-year on the daily continues to go higher and actually had a wealth signal come in this week or on Friday. Market theme, rising rates, think defensive. So large cap and value are in the lead. If we look at S&P 500 sectors, we could see that materials look pretty good still. Remember I said ore and steel prices were good. Energy still in the upper part, struggling to get back up. Staples look great compared to the others. Healthcare stirring as well. But what surprises me as the market's selling off, wouldn't you think we'd get defensive? But look at this, utilities and real estate just not participating. Now, seasonality. sell in May and go away. You've heard that your whole life. Maybe this year, like many years, that will be true. I just decided to look at 4-week performance with seasonality, and I'm just using the built-in seasonality tools in WealthCharts, and I opened up the seasonality layout. And if you look at S&P sectors, you've got only you got the spider, and then I believe 1, 2, 3, 4, 5, 6, 7, and 8 of the sectors. Some of them may not be around for 10 years. Some may not be positive, and we're looking here. If we look at the bearish ones, you could see that energy is actually bearish during this period of time. That's a difference. And look at what the leader is with a 4-week performance of average of 4.15%, up 7 out of 10 years between now and the end of June. So even though they've got the lowest wealth signal scores, the top 4, even the spider, even with the sell in May and go away story, there's seasonal strength here. Let's go into the marketplace and let's take a look at, go into sector scanner. So let me clear up some confusion here because somebody asked me this question. Why, when you look at something with the S&P 500 or the S&P 1500, as I've shown you the S&P 1500 earlier today, why does it say all the sectors are red and right here you see that healthcare is green? That's because I'm looking at a different set of the market. If you look at the numbers of stocks here, I'm really looking at a broad market here. So it may be different than what you see on CNBC or on other programs that are looking at the S&P 500 or the S&P 1500. So you get a much more broader, I think that's better, to be honest. And you can see on the broader, healthcare led on Friday, followed by materials, staples, industrials popping up here. If we look at the week, everything was down, but energy, healthcare, basic materials, energy, healthcare, basic materials are leading. If we look at algo scores, you can see that the strongest by algo on the daily, energy, industrials, and defensive, which to me are staples. And notice you see the AD lines here, and you can see predominantly losers across the board. No surprise with how negative the day was. So if we look at what's working now, and we'll just stick with the daily chart for right now, I might click healthcare, industrials, basic material, and staples. And I've got a feeling defensive and cyclical are both in, well, I think this is staples. All right, and now I can hit compare. And this brings up the industry groups in those sectors. Let's just go from down to, say, here. Not the way I wanted to do that. Let's try that again. Turn them all off. Click the first one and go down to gold. So I could look at the industry groups that best performed on Friday. I could look at the ones that on the week were positive. So I want to fill in a couple here. All right. And now I could ask the question about stocks. Now I want to point out medical devices have a crazy big number here. I bet when I go to compare, I'm going to bring up some medical device stocks that we would probably not even be looking at considering they're less than $1. So this one had either a reverse split, but it's hard to imagine something went from 60 cents to $6. That looks like a 1 to 10 reverse split. So perhaps the reason why healthcare looked this way is because you had a couple of things in there. AGRX also had a massive split from 38 cents to $3 and something. Actually, yeah, that was probably 2 10-to-1 reverse splits. So I suspect that the positive performance in healthcare will go away when those splits are put in the program. So if we want to do this, we might want to look at the top performing stocks. So let's look at daily percent change. Each week I do this a little bit different, and let's skip these at the top because You know what? There's some of these are so big gains. Let's look at algo score. So interesting. These things are just gigantic. So let's just go down here and let's go down to 740. First thing that I'm noticing, you may not be seeing this, is there's just a lot less stocks making it to the scan. Now here I want to make sure I'm on weekend review, which is what I put my bullish stock picks in. And then I'm going to hit apply there. So now I know I've got the right watch list updated. And now I'm going to hit add to watch list, and hopefully up here we'll see this, which we do. And I just dumped those stocks to that watch list. Now, one of the beautiful things about this program is that I could do so many different analysis on that watch list. I could go to Wealth Scanner, all right? And the first thing I usually do on Wealth Scanner is I look at my top-down indices to get a sense of what's working in the market. Now, just look at my settings real quickly. I want to add a couple of short-termers. I want to take away the weekly, and I want to make sure it has me as a swing trader. Perfect. Apply. And I could look at list of stocks, all the symbols in the marketplace, but let's just go back to my top down. So I made this a little faster moving. Let's see if it changes anything. Natural gas is up on top. I mentioned that natural gas pulled to the 17. I still believe natural gas wants to go higher. If this was a stock, I'd be buying it. And you could trade UNG. I've been long BOIL, B-O-I-L. Trade at your own risk. BOIL is one of these leveraged ETFs, and when it moves, but it moves both ways. Gasoline also looks good. And then you got commodities, oil productions. Here's your staples, your miners, oil services, energy, short the Qs. Notice you don't see a lot of technology names or things here. Now, I could then look at any of these groups in my, for example, my CAT scanner, and here's Biotech and Pharma. Remember I said I was interested in healthcare. And what I really liked out of this group was Cytokinetics. And why did I like Cytokinetics? And I don't know this company from Adam, so don't be deceived and think because I'm a doctor, I know this company. I've never heard of them before. I have a stock that's been in an uptrend. Okay, you could see it better, perhaps, not perhaps, reality on the weekly. Let me make this one a little bit bigger. There we go. Pull back and a reversal on the weekly. Took out the 200, the 50, and the 17 day on Friday, and it had a volume, a breakout, and momentum dots. This is intriguing to me. It's something that I will probably look at. It doesn't mean I would buy it. LEGN, Legend Biotech. You know, the big difference between those two, and I'll call that out because this is something that I've been very careful of, is here I'm below the 200-day moving average. I've got to believe that the 200 on the daily and the 50 on the weekly could be resistance. But if I go back and I look at the Cytokinetics, it's now above all those moving averages. Yes, this level here, 43.50, and then up here, 48.11 could certainly be areas of resistance. So there was some of the biotech and pharma. I could put all symbols in and see what comes up. And I usually rank by the number of dots. This is a paid for extra from the marketplace tools. If you notice over here, I've got Bongo Weekly. And one of the problems that we have in this market is we've sold off so much. A lot of the stocks that in the marketplace are, let's see if I can get, I guess we have to go down here. You can see just so many stocks are Bongo Weekly bearish. So when a stock is Bongo Weekly bearish, that means the weekly trend is down. So then you're dealing with what we call counter trend rallies. And as Rob Hoffman likes to point out, it's really hard to make money trading counter trend rallies. Carlyle Group here, or Carlyle Companies. This is one that also looks interesting here. Had a gap up on Friday with volume, breakout, and momentum. If you look down here, it's at 78%. or 70% rather, which means it's nowhere close to the greatest it's been extended over the last year. So even though it broke out, that might be something that is compelling. I could go down the weekend review, which is a large list of stocks in groups that I thought were potentially attractive, and you could see a lot of the 4 dots are here. There's a little discrepancy in the scanner and the charting for those people that have it. Working through it right now. Let's look at Avatar and I'll show you what I'm talking about. Avatar, to me, it has a big gap up, so it's got a big move here on volume. You see the volume dot is lit as well, but it closed at the bottom of the gap. That's less exciting to me than a stock that closes at the top of the gap. So I really only want to have 3 here, so we're going to work and get that fixed. Notice the weekly bongo here is bearish. Celanese, weekly bongo's bearish. I got to get through the 200. I probably would skip it. There's that Carlyle. FIVN is another stock that had a big gap up on Friday, but closed right at the bottom of the gap. Now that may also be because the market sold off hard at the end of the market on Friday. Look at the volume. You can see the volume dot, breakout, and momentum. It has a weekly bongo green. Why? Because look what it's come. You got higher lows here. We'll see if you get higher highs and prove that you're in a new uptrend. So I could go down the list. I don't know this guy. Who is this? GTY. $6 a cheap stock. Looks like one of those reverse splits, so let's skip it. And here's a stock that has been showing up on my scan for a while, and I guess there's some learnings here. Number one, just because it gaps up does not mean it can't go higher. So this stock gapped up a lot on gigantic volume on or about February 24th. This is the day, I believe, that Russia went into Ukraine. It traded up, pulled back a little bit, and gapped up again on Friday. So this looks actually very interesting. And again, it's only at 79%, so it's not even the most extended it's been. So, and it had an EMS come in. So that actually is a beautiful looking chart. Now look at this chart. Where's the resistance? There's no overhead supply. Since the only people that are lost money on this stock that are still holding the stock would be people that sold it or who bought it, and just the difference between where it opened and where it closed. That's a beautiful stock. Again, it has run some. So I usually rank them by my dots, and you notice every one of these stocks looks interesting. GoPro. It's got overhead supply and potential resistance at the 200. 3 dots coming out of a squeeze. Higher lows, higher highs. It's in a new downtrend. That's the bongo weekly has turned. I'd rather buy stocks that don't have the 200 over their head. Honeywell, broken record, gapped up here, closed near the bottom. So it's got volume and momentum, but it's got the 200-day moving average 4% above it. So I could go down through that list, and typically I do. I will say it's not a good thing, unless you're holding VXX, if you're long, to have VXX make this list. And look at VXX. This is a volatility ETF, and it's had a high volume, a breakout momentum out of a squeeze with a PSAR reversal. Both daily and weekly bongos are green. That may be one of the best looking stocks up here. Bad thing for the bulls. So from a top-down perspective, I can build this watch list. I have built a list of bearish stocks, and I could go into my scanner and I could just switch this from greater than or equal to less than or equal to, my bearish stocks from less than or equal to greater than or equal to. I've got the squeeze off. Nothing else is in my scanner. And then I might change it to a higher price stock to short. I'm not going to short a $5 stock. Hit apply, and now rank them by number of dots. And I'll tell you, I'll look at AbbVie, and I'm not at all recommending you short AbbVie. But here's what I can tell from the scanner. I can tell that the price is 146. I know that it was higher, but that's irrelevant. It's not in a squeeze. It's got three bearish dots, okay? It does not have a failed new high or new low. And since the bongo weekly is bearish, it must have flipped to a weekly downtrend, and it's in a daily downtrend. High jump minus 28%, which means it's not extended. And let's just take a look at AbbVie. So AbbVie had volume, breakout, or breakdown in momentum, closed at the low of the day. And, is this a potential short? Everybody has their own way of shorting things. The way I like to trade is when I see there's a pretty significant hammer here or bottoming tail, my guess is that this stock is going to go higher from here. I don't know that, but where I'd like to short it would be if it comes up here and stalls at this level or at the 50 and heads back down. After a drop like this on a big leader, I don't think I'd be looking to short it. I'd look to short it from a higher level. ABC, AmerisourceBergen. Again, do I want to short it here as it broke above the 50? It's down a lot. It's gone from, and I know this company well, they actually bought one of my businesses, or two of my businesses, from 167 down to 151, 16. So a 10% drop. Do I want to short it? Because look at here when it dropped down, it moved back up. Dropped down, it moved back up. No, I want to wait for this to move back into this 17-day or at least back into the 50. Let it run up to the 50 and fail, and then let me consider shorting it. ADI. Now, this is where the squeeze comes in handy. Why? Because this stock sold off here, rallied into the 17 and 50-day moving average, and broke down on Friday. If I was looking for one I would be more interested in taking a short in, it might be analog devices because it failed at the moving average. So just like on the long side, I can start to bring in stocks that have bearish dots. And for those that have no idea what I'm talking about, there are four potential dots here. Dot number one is a big gap. Now, I do not have big gap down in. It's coming. I've got big gap up. Dot number two is big volume. And if you look at it, you see the volume, even though this is down volume, it was a down day, is one of the biggest volumes on the chart. And it's going to compare today's volume, or in this case Friday's volume, with some recent past volumes to get that signal. The next one is a breakout, or breakdown in this case. And then the third here is a momentum. So gap, volume, breakout, momentum. Then you have a squeeze, status of the PSAR. These green and red dots are failed new highs and failed new lows. Here are my bongos. All three are bearish. And here is the high-low jump. And as long as it's not above 95 or below minus 95, it's not giving me a signal. And the other thing I want to show you is I like to short a retracement. So the daily bongo actually turned green for a couple of days as it retraced into the moving average, and it went red again as we failed. So this is one that has a lot of the criteria. I haven't done a deep analysis. I haven't looked at the fundamentals. I'm certainly not telling you to go short it. What I'm basically showing you is I'd rather find a stock that's pull back into the moving averages and consider perhaps a short than a stock like AbbVie, which has been a great leader and had a dump in the market because, look at the tail here. My guess is it goes back up. It might give me a great shorting opportunity. But I can use my dots both to the long side or to the short side. So let me switch them back to the long side, look at one or two other things, and then I'm going to say goodbye for the night, for the day, for the weekend. All right. I have a list which I call my combo leaders list. I build this list for multiple scans I do in multiple different programs, and I'm trying to create a list that I like to watch during the week of what I think are the stocks that are most likely to, if there is a rally come in, that might be leaders. AVTR, and this is the problem, is you've got stocks that have gapped up here in a downtrend with lots of overhead supply. Even though it's got 3 dots, it couldn't hold that 50. If I wanted to, I might be more inclined to short this stock than go long, but it's not, after that gap up, no, I'm not interested. Celanese, underneath that 200. There's that Lanthus. So here's that Cytokinetics, a stock that I showed you early on. And again, this is one that if I was looking to go long, and I think to go long in this market, you need to be very careful, be prepared to be short from a time frame, and don't go with big position sizes. And people ask, but Jeff, how do you know if you're going to take that trade on Monday? I have no idea, because I have no idea what the market's going to do. If the market opens up, I'm probably more inclined to look at longs. But what if the market opens up 200 points down? I'm no interest. So I typically would set a bunch of alerts or potentially buy stops. And I would set it, if I'm going long, above the high of the day. If there's a support or resistance line close, I might use that. And then I'll set a sell stop immediately upon taking the trade. If I'm going short, then I might typically set a stop below the low of the current bar. Because if the market trades up, I don't want to take that short. And then, once that trade is taken, take a stop above and trail it in different ways so I don't get hurt if the market goes against me. So I'll be looking at this list. Here's your VXX. So that's one of my favorite ways of doing it. During the market day, I might look at the Wealth Signal. Let me pull this up here. Wealth Finder, rather. Wealth Finder allows me to look at different time frames and see if things are starting to move. I could look at stocks on my buy watch list. Here's that Lanthus here on Friday. I could look at stocks that I might own currently, which, as I said earlier, are much less than I typically would have across my portfolios. Here's that combo leaders list. I might be looking to see which things are starting to move to the long side or the short side. Another thing that I like to do within this program, go back to Marketplace Dashboards and go into Wealth Scanner. I know a lot of people don't have my CAT scanner. Hopefully there'll be opportunities to buy it. We'll have some educational programs. And if you don't have WealthCharts, usually those educational programs, whether I put them on or Rob Hoffman or others who work with WealthCharts, they typically offer a chance to purchase the program, sometimes at a discount, as well as the add-ons. The add-ons, for mine at least, are permanent. You pay once and they're lifetime. But if we go back to this, let's go look at that weekend review, the list of potential long things I was looking at. So I could just put this list in, let it run its time, and then start looking at the highest rated stocks and go down the list. REI, nice uptrend, cheap stock, so it's a cheap energy stock. We know we like energy. Yeah, I mean, it's a nice looking chart. It's had a nice run up here. Volume is falling off here. SWX is a natural gas play. Give us a flag. There are ways to trade this if it breaks above those highs in the pennant formation. Blackstone Minerals, BSM, giving us a flag, a bull flag. EQT, again, all right, here we go. EQT, wait, my bad, there's Blackstone. So Blackstone Minerals not given, here was the flag and it broke out. So you can go down the list. PBF like Valero, Phillips 76, among some of the refiners have been strong. So I will spend time and go through this list Now, typically, these stocks have run already. Here's a stock that's been running, and now it's pulled back. This is Valero. So I'm finding on this list some of the best stocks in the market. Now, occasionally, you'll find something on this list that's highly ranked. Here's Atlantheus. That might be at a buyable opportunity. And as I pointed out earlier when we looked at this stock, it had a big gap up here, and it had a big run thereafter. So if you had bought it when it gapped up at 39, it's now up to 69. So here you had another gap, a smaller gap. It's not extended, or maximally extended, I should say. So that's what I liked. And I'm just looking through to see Scorpio tankers. I know marine, um, the marine shipping looks strong again. It's already starting to run. Remember how bad Friday was? How bad the week was? Friday, Thursday, Wednesday, Tuesday, Monday. Sold down Monday, gave a hammer up the rest of the week. And on Friday, it actually closed up a teeny bit, even though it came off where it opened. That's a strong stock considering the market. CTIC is one that I'm in. Again, the power of the big gap here. And here's a day where the gap actually fired because it closed. Let me see if we can make this look even better. This one closed at the high of the day. Okay, that's a gap I'm interested. So this was a big gap up, and you can see here 4 dots, a big gap, volume, breakout, momentum. Happens to be a drug approval day. Now, a lot of people, including somebody I'm mentoring in my business to someday replace me, took this as an opportunity to sell. A big gap up on volume from a base can be the beginning of a big run. And you can see the stock closed at 310 on the gap up day and it closed at 511. That's a huge move. So that's CTIC giving us perhaps a pennant here and another opportunity to come in. So again, take what I say as being education. I have not told you buy points, sell points. I don't know your portfolio, your risk tolerance. I'm showing you how I parse the market, how I look for the stocks of the leading industry groups, some of the different tools I use, and I hope that you will be able to manage the current market pullback, the bear market that we're in, at least on the NASDAQ and the Russell, because the greatest rallies of my lifetime are those rallies that follow a bear market, such as March 23rd of 2020, March 9th of 2009. You got to have capital left to make back what you lose in that bear market. Trade safe. Talk to you next week.